Today, I'm going to cover some of the key findings from the 2022 SaaS Benchmarks report put out by OpenView. Now, OpenView is a great venture fund. They're based on the East in Boston. And every year they come out with this SaaS Benchmarks report. If you want to check it out, the link's in the description. You should definitely give it a read, especially if you want to invest in SaaS businesses. Now, SaaS stands for Software as a Service. Basically, those different pieces of software you use all the time and pay for on a subscription basis. Think like Spotify, or maybe use Google Docs or a bunch of these other, software products that sit in the cloud. Typically, consumers don't buy them, but enterprises do. So like CRMs like Salesforce and others are good examples of SaaS businesses. Now, a lot of venture capitalists invest in SaaS, and the reason that we invest in SaaS businesses is because they have this recurring revenue piece of what they do, and so you have a lot of visibility into future revenues. Their products tend to be really sticky with customers. Their costs tend to be fairly low, so margins are really high, and they have the ability to dominate their different sectors in which they operate, creating kind of all the right ingredients for a great venture investment. That said, when you're evaluating startups, particularly SaaS ones at the early stages, it can be kind of hard to tell which ones are winning, which ones are losing, unless you dig into the metrics. And that's really what I want to cover today, is going through some of these metrics, what they are and what the standards are, right? If somebody comes to you and says, oh, well, I have a CAC payback of like 24 months, is that good? Is that bad? What does that mean? And that's really the goal for today. So part one of what we're going to do is we're going to walk through some of the findings of this report. And part two, I'm going to help you understand how to interpret these different data points so that you can use them as an investor or as a startup entrepreneur to best kind of benchmark and assess either the deal you're looking at or the company you're running and how it compares to what other venture capitalists are looking at. And how to know if it's, the metrics you're looking at are good or really good or really poor in areas for improvement. So for the sake of the video too, I'm going to be looking at businesses that are generating anywhere between kind of less than $1 million in revenue up to 10 million in revenue. And we'll talk about the different metrics that they pulled in this report for each. Now, what's cool about the OpenView report is that they've partnered with ChargeBee to be able to pull in a ton of data. They've partnered with a ton of different venture capital funds out there and all of their portfolio companies. And so you're basically pulling in this data. It's all anonymized and aggregated, but to see like how all these companies are doing on average in these different areas. And so if you see a metric and you're doing better, then you're doing above average. And if it's below, you're doing below average. So the first one I wanted to talk about is year-over-year growth. And in the report, what they found is that companies over the last 12 months, now this is Q2 of 2021 to Q2 of 2022, those companies were growing anywhere between 50 to 100% year over year. Now, I'll tell you as a venture investor, when I'm looking at growth, and in this case, we're talking about ARR growth. Now, SaaS businesses, you usually don't really look at revenue. You usually look at what's called ARR, or annual recurring revenue. And the reason for that is because the idea behind it is that if we stopped selling new product today and we just had our current customers and our current subscription, our ARR tells us 12 months from now how much our revenue would be. And it ends up being just a better metric to get a feel for how the company is performing and growing, because you want to be tracking this like recurring side of the business. Sometimes companies will have non-recurring revenue, and that non-recurring revenue is going to be valued lower than recurring revenue is, simply because it's non-recurring, right? It's just a one-time revenue. And so that's another reason why VCs really care about this like ARR side of things. So going back to what I said earlier, these businesses, if you're smaller, doing less than $1 million in revenue, the average is about 100%. Now, I'll tell you, for less than $1 million in revenue, to get me excited as a venture investor, I really want to be seeing quite a bit greater than 100% year over year in ARR. And the reason for that is because a lot of the companies I look at are growing at higher than that number. And so for you to stand out, you really need to be growing at above 100% year over year in ARR. Now, get me wrong, that's really challenging to do, but I mean, that is kind of where the average is today. Now, this is for sub $1 million. I would also argue that once you're above about $1 million, $2 million, really want to be seeing somewhere in the like 100 to 200% year over year ARR growth, which would be substantially higher than the 79% that they're seeing on average in this report. And then it kind of blew my mind that for companies that are doing somewhere between $2.5 to $10 million, that they're only growing by 50% year over year. I would expect that percentage to be a lot higher. What that tells me is that you're starting to see kind of this bifurcation in these companies, where the high quality companies are probably growing at quite a bit above 50% year over year. But there are a lot that are kind of stagnating. And you do see that a lot of that in venture capital, that companies will start, if they're not going to end up being successful, a lot of them do really start stagnating in that like $2.5 million to $10 million range. So in some ways, I was surprised to see 50% year over year ARR growth in that range. But on the other hand, I guess I can see how it kind of makes sense. The other one I wanted to talk about that I thought was interesting was just S&M spend. That's sales and marketing. So how much is your company that you're evaluating or you're running generating in sales and marketing expense? And a lot of them were hovering around somewhere between 25 and 34%. That feels about right. Usually about a third of your revenue is going to go towards sales and marketing. So anyways, if you're below that and you're still seeing really high growth, that would infer that you're either being incredibly efficient on your sales and marketing dollars because of the way you've structured that, or it could be that you're really focused on what's called product-led growth, where you're really reliant on word of mouth and referrals and other things to really drive revenue, and you put a ton of focus into R&D. In those cases, usually you see R&D expense be quite a bit higher than average for a sales for a product-led growth business. And the flip side is you could have like a sales-driven business where the company has really got like a huge army of salespeople and their product is good, but maybe not the very best that's out there, and they're really just kind of pounding pavement to drive growth. I think both honestly can be successful, although I think in the long run, if you want to build a really strong, really successful company that has real staying power, product-led growth, where you're really focused on building kind of the very best product, usually makes the most sense long term. Another one that I wanted to touch on was the gross margins that they flagged in this report. So for earlier stage companies or smaller businesses that are doing less than $1 million, they're at about 70%, all the way up to 80% gross margin for businesses in the $2.5 to $10 million in ARR range. Now, gross margin is incredibly important. If you look at what's happening in the public markets right now, a lot of the businesses that are underperforming are doing so from like a stock perspective. They're doing so because their gross margins are very strong. They could have really strong top line growth. They could even have like good profit margins on the bottom end, but the gross margin really matters. And the reason for that is because the gross margin kind of dictates what money you have to invest in your business to drive, future growth, for example, more product development, whatever it might be. And if you have really low gross margins, then it makes it really difficult to have the cash you need to invest in those other areas and really accelerate growth and product development. So, it's not surprising to me that the smaller businesses have lower gross margins. Usually you're still trying to figure things out. You don't have the scale that you normally would. You might be doing more custom projects and products for customers. You're implementing new features and so forth. You may have to spend more time doing onboarding and hand-holding. So that's not a surprise. But if you're an enterprise SaaS business and you're not in the at least 70% gross margin and ideally pushing up towards 80% gross margin, then you really need to step back and take a look at your business and know that you're probably going to take a hit on valuation, particularly in this market. The next one that I think is super relevant to talk about right now, as everybody expects us to be heading into a recession, is burn rate. Now, burn rate is simply the amount of money that your company is spending to keep everything running when you also take into account your revenues. So essentially, like if you have $100 in your bank account and you're spending net of everything that comes in and out the door $10, then your monthly burn rate is going to be that $10 every month, right? $10 goes out the door that you can't really recoup. And if you've got $100 in the bank, then that gives you a runway, as we call it in the industry, of 10 months, right? So burn rate's super important because right now a lot of companies are trying to extend their runway by lowering their burn rate. And that's why you're seeing a lot of companies that are executing pretty substantial layoffs, is because they're trying to reduce costs wherever they can to extend that runway. I thought it was interesting that both companies that are doing $1 million up to 10 million are burning about 175K per month, which, it depends on how much money they have in the bank. Typically, companies that are generating more in revenue will hopefully have a little bit more in revenue. And I was honestly surprised to see that the burn rate was about the same, on average in both the $1 to $2.5 million in revenue or ARR, as well as those from $2.5 to 10 million in ARR. I think that's probably a reflection of all of the cuts that a lot of these businesses are making right now. So let's say like you just raised a Series A round and you raised like $5 million and you're burning 175K a month. Well, that means that, in 12 months, if you've got 5 million in the bank, like you're going to use up roughly half of that, maybe a little bit less, but about half. It's about 2.1 million of it. But you got to take into considerations that there's going to be ebbs and flows from seasonality or from, you missed closing that one client that really hurt on the top end, and so you ended up spending more on the bottom end, et cetera, et cetera. And then you probably want to be out fundraising when you've got about 12-ish months left of runway, especially in this environment. I mean, I would want to give myself a big, healthy buffer of window, because the last thing you want to do is go out and fundraise and not have enough money in order to get to a deal. And then you're in desperate, dire straits, and VCs and investors can really take advantage of that situation. So let's talk about some of the other metrics that I thought are super important. So one is CAC payback. Now, CAC payback period, what that refers to is your customer acquisition cost. That's your CAC. That's what it costs you to acquire a customer. And then how long it takes for that customer to generate enough revenue to offset how much you spent to acquire them. So, for example, if a customer is paying me $10 a month and it costs me $100 to acquire them as a customer through marketing spend and sales commissions and salaries and all of those things, then in that case, it would take me 10 months. That would be my CAC payback period, because it cost me $100 to acquire them as a customer, and then they're paying me $10 a month, so $10 CAC payback period. I think in general, like a healthy place to be as a SaaS business is about a year. And that's really what the data points out, is that, small businesses are about 7 months, which makes sense because usually that's like low hanging fruit, right? Customers that are really excited about what you're doing, and, you've probably built your solution for a specific set of customers. And so getting in front of them, getting them excited and signed on is usually cheap, and you're getting all that low-hanging fruit. But once you've eaten up all the low-hanging fruit, you got to stretch a little bit higher to get the higher fruit, right? And so that just means you're going to have to spend more in sales and marketing. Your CAC is going to go up, and then by default, your CAC payback period will also go up. But the data, points out 7 months to 12 months, and that's exactly what I'd expect to see there for kind of good, healthy, on average companies. The next one that's interesting is what's called gross dollar retention. Gross dollar retention is basically the revenue that you start with at the beginning of the year with a customer and where you end up at the end of the year. And usually, you're going to have churn. You're going to have customers leave. Even if every single customer loves your product, you're still going to have churn, and it's going to show up in gross dollar retention. That could be because, the company went out of business. That's like one of the most common ones. It could be because the company got a new employee to take over that division, and they decided to bring kind of their own tech stack, and they ended up getting rid of yours. Even though it was a great product, it just didn't fit in with their new tech stack. There could be a lot of different reasons. On the small business side, sometimes it's even just like, their credit card expired and they didn't even realize that. And so, you have some churn here and there. Gross dollar retention is, if I start with $1, how much of that buck do I end at the end of the year? And what this report was showing is that it's about 97 for smaller businesses, dropping all the way down to 90%. I thought that was interesting. My guess is that it kind of is related to your CAC situation where, your low-hanging fruit are probably customers that are really excited about the product. And as you start stretching like who the product it really works for, because you're trying to get, you're trying to broaden the market to as many people as possible. And just some of them are going to sign up, they're going to try it, they're going to realize it's not a fit for them, they're going to drop off. Either way, what I would want to see is definitely above 90%. And, I think world-class businesses are in excess of, probably 95% on the gross dollar retention side of things. The number that's more interesting is the next number, which is net dollar retention. Net dollar retention is if I look at all my customers in total and I take out those that churn out, those that leave, right? That's my gross. And then I add in those that like expanded, what does my churn look like? And here's the thing, you should have negative churn if you're a very high quality SaaS business. And what does that mean? That means that your current customer base is upgrading, adding more seats, adding more product features, basically just paying you more for the product than you are losing in other customers. So for example, if I have two customers and one customer goes from a $100 annual contract to a $300 annual contract because now they've expanded across the whole business. And I have another customer that was a $100 customer and they just disappear, right? On my gross retention number, well, I started the year off with 200 and at the end I only ended up with 50, right? But that other customer then upgraded and added another $200 in business. And so my net dollar retention in that case would actually be a lot higher. It would be like 200%, right? Because even though I lost $100, I gained $200. So I'm up $100 overall. That's what net dollar retention is. The very best businesses probably hover in the 120 to 130%. Which means even after taking into consideration all of the customers they lost, they still grew ARR during that time period for that cohort by 20 to 30% due to expansions and in sales with their current customer base. The report showed that companies on the low end are at about 100%, which makes sense. Like these businesses are so new, these customers are so new to this company that they haven't had enough time to renew. And if they have, right, in many cases, they might be small businesses and they're still trying to figure out product market fit at that size. And so they may be losing some companies at a greater rate that's like offsetting some of their wins, whatever it might be. So 100%, I mean, it feels low, but it makes sense. And honestly, at that range, net dollar retention's not doesn't really tell you a whole lot, honestly, because you just don't have enough customers yet for the data to be meaningful. But what was interesting is that above that, it's about 105% on average, and that feels about right. But I think there is a bigger delineation between like world-class, which as I said is probably about 120-ish%, and then kind of below that, everyone else. So an average of 105 seems to make sense. If that was interesting to you, check out some of my other videos where I talk about more of some of the stuff behind this. For example, like why there are so many layoffs right now and what's going on. And we can see in the data here that a lot of that is companies have high burn rates and they're trying to get those down, which in turn relates into some of these layoffs that you're seeing. Anyways, check out that video for more details. Thanks for joining.